Hey guys, welcome back to our channel. Thank you for joining us today. Today we'll be speaking about if you have $5,000 in the bank, do these 5 things right now. Please watch the entire video to figure out all the details. And guys, don't forget to like, share, subscribe, and click the bell notification. Alright then, let's get started. $5,000 is unlikely to change your life, yet it is likely to change how you invest or give you a jumping off point to begin investing if you're not as of now. A sum frequently leads many individuals to begin looking for ways of growing their cash. You too may think, how might I put this cash to more readily utilize? We as a whole should have savings on hand for a rainy day. A decent guideline is to have what might be compared to 3.5 years of fundamental living costs in a savings account earmarked for crisis. Like that, assuming you lose your employment or something major breaks in your home, you'll have the option to manage what is happening without being forced into obligation. As it may, many individuals are glaringly behind on their savings. Last year, the Federal Reserve Board found that 39% of Americans needed more cash in the bank to cover a $400 crisis. Assuming you're essential for that measurement, you'll truly have to attempt to top off your savings account as quickly as could be expected. Then again, assuming you have a solid degree of savings, you might be wondering what to do straight away. What's the ideal way to invest $5,000? That relies upon you. However, we have our thoughts. One of them will undoubtedly suit your risk tolerance and objectives, and every one of them is within reach. Assuming you're on track with all of your other financial objectives, for example, saving for a wedding, vehicle, or home, here are the ideal ways to invest that $5,000. Number 1. Invest in your 401k and get the matching dollars. We should imagine you live beautifully and efficiently. You share a modest loft with 2 flatmates, live in a walkable city, spend nothing on transportation, and cut basic food item coupons like no one's business. Assuming this is the case, you could burn through $1,500 a month on fundamental costs. So $5,000 is enough for your rainy day account. You can then continue toward long-haul savings. To be specific, funding an IRA or 401k plan through your manager. Similar to a 401k, an IRA is a retirement account. You need not bother with a business to have one. You can open an IRA at any online broker. Many don't have a record minimum. Those require less than $5,000 or postpone their minimum. Retirement might appear far, not quite right. However, you'll have to save independently to guarantee that you have sufficient cash to live comfortably as a senior. And while your closed-term savings should take priority, assuming your just-in-case account will own you, you can zero in your extra cash on building a retirement fund for what's to come. Investors of every kind imaginable have 2 or 3 objectives that are almost all-inclusive. People want to resign, and they'd rather not settle charges if they don't need to. Charge advantage retirement accounts like 401ks and individual retirement accounts, or IRAs, can assist you with working toward both of these objectives without a moment's delay. You should continuously contribute the minimum expected to get a business 401k match whenever offered. Anyone with available income can set up an IRA or some likeness thereof, from independently employed contractors to representatives of private companies and Fortune 500 firms alike. It's never too right on time to fire, setting yourself up for your brilliant years, and retirement accounts offer one compelling method for investing $5,000. Assuming you have a 401k, your company offers to match your commitments, and you're not taking it up on that proposition, this choice is easy. Go after that match. Many companies match half of your commitments, up to 3% to 6% of your compensation. It's the most noteworthy guaranteed return in investing. You normally can't store a singular amount like $5,000 into your 401k. However, you might find that having that cash in the bank gives you room in your budget to begin grabbing those matching dollars. The 401k commitment will make your paycheck more modest. However, you can reimburse yourself for that $5,000 either after every paycheck or at whatever point cash runs short for the month. Number 2, utilize a robo-advisor. You could fabricate a portfolio of ETFs or have one of those PC-driven advisors manage a pre-constructed portfolio for you. Robo-advisors offer total portfolio management. You'll pay for taking the path of least resistance. Generally, a management charge of 0.25% to 0.35% of your record balances each year on top of the ETF cost ratios. Nonetheless, there are a couple of free choices. Wealthfront has a $500 minimum and manages up to $5,000 for nothing. Axos Invest has a no minimum and is free indefinitely. Charles Schwab's advisor, Intelligent Portfolios, demands $5,000 and utilizes its assets, however, charges no management expense. Number 3. Open or contribute to an IRA. The annual IRA commitment limit is $6,000 in 2021 and 2022, $7,000 if age 50 or more seasoned, so you're simply a hair away from reaching it. Being nearby could persuade you to pinch together the rest. However, regardless of whether an IRA is the best home for this cash, if you don't have a 401k or have proactively made your matching dollars. A well-being savings account is an amazing investment vehicle for those with high deductible medical coverage plans, albeit planned as a record for individuals and families to save tax-exempt for cash-based clinical costs. An HSA can likewise enhance other retirement savings accounts, particularly if the record proprietor can pay clinical costs from another source. In 2020, the law permitted individuals to contribute $3,550 and families $7,100 to an HSA. Depending upon the sort of HSA, proprietors can invest in both fixed income and value investments, and all income and capital gains develop tax-exempt. Depending on the plan, you can utilize an HSA very much like a 401k or IRA, says Shobin Uralil, head operating official and fellow benefactor of Lively, an online HSA supplier. Number 4. Buy commission-free ETFs. A $5,000 investment gets you past most standard common assets and index store minimums, typically drift somewhere between $1,000 and $3,000. However, a couple of common funds don't make a portfolio diversified. The exception is inherently diversified deadline funds so that you can place your full investment in a single asset. These can have high cost ratios, yet are one option for investors who like to be hands-off. Exchange-traded funds, or ETFs, are similar to common funds when you buy one portion of either reserve. You're buying a little slice of that investment's holdings. The prominent difference between the two is how they're traded. An ETF can be traded similar to a stock. You can likewise see the price of the ETF change continuously. Shares of a common asset, then again, are transacted exclusively toward the finish of the trading day. Investing in 5 $1,000 minimum index funds would buy you an equivalent portion of the 5 kinds of investments followed by those funds, which likely isn't a portfolio you want. Many investors as of now have an understanding of wide market stock and security funds, which were touched upon earlier. Investing in some mix of low charge, market tracking fixed income and equity funds is an incredible hands-off method for writing consistent economic development long term. Yet even those diversified stock funds can be volatile. For anyone investing in taking the less common direction and committing to that way for the long run, low and minimum volatility exchange-traded funds offer an impressive bargain. Investors at large have seemingly ignored them. The absolute biggest funds have outflanked the S&P 500 throughout extensive periods while taking less risk, investing in a diversified portfolio of traditionally lower volatility stocks. As far as year-to-date returns, the iShares Edge MSCI MinVol USA ETF USMV has almost bounced back from the mid-March auction. The asset is relatively modest with a 0.15% cost ratio. Enter ETFs, which you can buy through that IRA or an online brokerage account. ETFs are index funds that trade like a stock. You avoid the entire routine with minimums and instead buy in at an offer cost that is, in many cases, much lower than the typical asset minimum. You could buy more funds, get more diversification, and spread your cash in a manner that checks out for your age and risk tolerance. ETFs generally have low cost ratios, yet you'll want to zero in on commission-free ETFs so you're not paying an expense each time you buy or sell. Those charges can approach $10 and truly haul down a little investment. Most dealers offer a list of commission-free ETFs. Number 5. Trade stocks. In your savings account, the cash you have will presumably pay minimal interest, especially given today's rates. Then again, if you open a brokerage account and invest a portion of your cash there, you'll get an opportunity to develop it into a lot bigger aggregate. Whenever you're set with your secret stash and are on target with your retirement savings, you can invest additional cash in a brokerage account to buy stocks or shared funds with the potential for substantial returns. There's a threat involved in investing, so you should be secure with your just-in-case account before you get it done. You stand to amass much more abundance in a brokerage account or retirement plan, which additionally becomes invested than in a traditional savings account. If you're the glad proprietor of a $5,000 savings account, congratulations, that's an impressive accomplishment. However, don't expect your work is finished. You might require more cash than that to cover yourself for emergencies, and even once that objective is accomplished, you should still strive to continue investing and saving for retirement. Fortunately, you can utilize the strategies you used to save your first $5,000 to save your second $5,000 and much more cash. Trading stocks has a charm, and if you've been feeling the draw, this moment might be the opportunity to take care of business with a tiny level of your portfolio. A decent guideline is to limit stocks to 10% or less of your portfolio and dedicate the remainder of your cash to minimal expense funds intended for retirement. You'll first need a brokerage account to buy stocks, which you can set up in around 15 minutes. Then whenever you've added the cash to the account, you can follow the means underneath to find, select, and invest in individual companies. It might appear unclear at first, yet it's truly straightforward to buy stocks. The following are 5 stages to assist you with buying your first stock. Number 1. Select an online stockbroker. The easiest method for buying stocks is through an online stockbroker. After opening and funding your account, you can buy stocks through the dealer's website in merely minutes. Other options include using a full-service stockbroker, buying stock directly from the company. Opening an online brokerage account is simple as setting up a bank account. You complete an account application, provide an identification confirmation, and pick whether you want to support the account via mailing a check or transferring funds electronically. Number 2. Research the stocks you want to buy. Whenever you've set up and supported your brokerage account, it's time to dive into the business of picking stocks. A decent spot to begin is researching companies you know from your experience as a purchaser. Try not to let the deluge of information and constant market twirls overpower you as you direct your examination. Keep the objective clean. You're looking for companies you want to turn into section proprietors. Warren Buffett said, "Buy into a company since you want to claim it, not because you want the stock to go up." He's found real success by following that standard. Whenever you've identified these companies, it's time to research. Begin with the company's annual report, specifically management's annual letter to investors. The letter will give you a narrative of the business and provide the setting for the numbers in the report. From that point forward, most of the information and analytical tools that you want to assess the business will be available on your representative's website, such as SEC filings, phone call transcripts, quarterly earnings updates, and ongoing news. Most online representatives additionally provide tutorials on utilizing their tools and even basic seminars on picking stocks. Number 3. Decide how many shares to buy. You ought to feel positively no strain to buy a certain number of shares or fill your entire portfolio with the stock at the same time. Consider starting with paper trading using a stock market simulator to consider going all in. With paper trading, you can figure out how to buy and sell stock using play cash. Or on the other hand, if you're prepared to put genuine cash down, you can begin little, minuscule. You could buy simply a single offer to discover what it's like to claim individual stocks and whether you have the resistance to ride through difficult situations with minimal risk misfortune. You can add to your position over the long haul as you waste the investor's strut. New stock investors might likewise want to consider fractional shares, a relatively new offering from online representatives that permits you to buy a portion of a stock rather than the full offer. It means you can get into pricey stocks with a more modest investment. SoFi Active Investing, Robinhood, and Charles Schwab are among the merchants that offer fractional shares. Many brokerages offer a tool that changes over dollars and adds up to shares. It can be useful if you have a limited sum you'd like to invest, say $500, and you want to know how many shares that sum could buy. Number 4. Optimize stock portfolio. We trust first stock buy denotes the beginning of a lifelong excursion of effective investing. If things turn difficult, recollect that each investor, even Warren Buffett, goes through tough situations. The way to come out ahead in the long haul is to keep your perspective and focus on what you can handle. Market twirls aren't among them. In any case, there's a link of things in your control. When you're familiar with the stock purchasing process, get some margin to dig into other regions of the investment world. Opening a brokerage account and buying stocks is an incredible first step. However, it's simply the beginning of your investment venture. Your investing time horizon is a critical determinant of how much investment risk you can handle and is subject to your age and investment objectives. For instance, a young professional likely has a long investment horizon, so they can take on a significant risks, since time is their ally regarding bouncing back from any misfortunes. However, consider the possibility that they're saving to buy a house within the following year. Their risk tolerance will be low since they cannot stand to lose a lot of capital in case of abrupt market correction, which would jeopardize their primary investment objective of buying a house. Likewise, conventional investing methodology recommends that individuals in or close to retirement ought to have their funds conveyed in safe investments like securities and bank deposits. Yet in a period of incredibly low interest rates, that system carries its own risk, mainly of the poor purchasing power due to inflation. In addition, a retirement individual in their 60s with a fair pension and no mortgage or other liabilities would presumably have a sensible measure of risk tolerance. An investment that can provide twofold your cash in a little while is more invigorating than one that might do much in 20 years. The issue here is that a stimulating, high-development investment will likely be more unpredictable than a sullen, consistent eddy investment. The superior the volatility of an investment, the riskier it is. This expanded volatility or chance is the value an investor pays for the charm of more significant yields. Well, that's all we have for today. If you enjoyed today's video, don't forget to like, share, and subscribe.